Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Friday, August 7th, 2026, and this is one of those mornings where a single data point could genuinely move markets. July NFP drops at 8:30 ET, and with the Fed deeply divided and September rate hike odds already sitting near 55%, the stakes are unusually high. Let's get straight into it. Lizzie, how is the market positioning itself ahead of this print?
Morning, Robert. Cautious is the word. Nasdaq futures are edging modestly higher. The Dow is wavering, and S&P 500 futures are essentially flat, up about 0.2%, which tells you traders are not making big directional bets ahead of this number. The setup heading into 8:30 is one of the most binary I've seen in months, because the range of outcomes is unusually wide, and the Fed's current posture means the data could cut in either direction with meaningful consequences for equities, rates, and the dollar all at once.
JP Morgan is warning that a print above 150,000 could trigger nearly a 2% sell-off in the S&P 500. That classic good news is bad news dynamic. How seriously are traders taking that scenario given June's weak 57,000 print?
Traders are taking it seriously, but not panicking, because June's 57,000 was genuinely soft and sets a low bar for comparison. So a bounce was already baked in as the base case with consensus sitting around 80,000 jobs. The concern is really at the tail. A print north of 150,000 hands, the Fed the justification it needs to hike in September, and with the hike probability already at 55%, a strong number could push that well above 70% and reprice the entire rate curve in minutes. JP Morgan assigns 65% odds to payrolls exceeding 60,000, and the softer 20,000 to 60,000 scenario, the one that would actually lift stocks up to 0.8% on the S&P, carries only a 25% probability.
Steve, walk us through the full employment picture heading into this NFP. ADP came in at just 44,000 against a 70,000 forecast, JOLT slipped to 7.36 million, and jobless claims printed at 199,000 yesterday. Are these sending a consistent story or mixed signals?
The data this week is telling a broadly consistent story of labor market deceleration, though not outright collapse, and it sets a genuinely uncertain backdrop for this morning's print. ADP came in at only 44,000 against a 70,000 forecast and well below the prior 95,000. The smallest private payroll gain in 6 months and a meaningful signal of hiring hesitation in the private sector. JOLTS for June printed at 7.359 million, slightly below the 7.4 million forecast and down from 7.537 million previously, confirming the trend of gradually cooling labor demand even if openings remain historically elevated. Yesterday's initial jobless claims were actually the outlier on the firmer side. 199,000 came in below the 202,000 forecast and nearly identical to the prior week's 198,000, pushing the 4-week average below 200,000 for the first time since before the pandemic, which signals that while hiring is slowing, layoffs have not yet accelerated in any meaningful way.
Steve, ISM manufacturing PMI came in at 55.6 this week, beating the 54 forecast and up from 53.3. How do you square that with an ADP print of only 44,000?
It appears contradictory on the surface, and the honest answer is that these two indicators are measuring different dimensions of economic activity that can diverge for extended periods. The ISM manufacturing PMI at 55.6, solidly in expansion territory, reflects factory activity, new orders, and production conditions buoyed by reshoring trends and defense-related spending that don't necessarily translate directly into broad private sector payroll growth. ADP is capturing actual hiring decisions, and businesses appear to be running lean on headcount even as order books stay healthy, a classic late-cycle dynamic where productivity and existing workforce utilization take priority over new hiring. The warning embedded in that otherwise solid ISM reading is that input costs hit a 14-month high in the same report, which adds another inflationary layer heading into today's Fed-sensitive number.
With PCE inflation at 3.7%, the Fed holding at 3.5% to 3.75%, and 3 officials already dissenting in favor of an immediate hike, how much does today's NFP actually move the needle on September Fed pricing?
Quite significantly, and that's what makes this particular NFP unusual relative to a typical jobs Friday. With real rates effectively negative, the Fed funds rate sitting against PCE of 3.7%, the Fed is already in a difficult position, and 3 dissents signal genuine internal pressure that today's data could either validate or diffuse. A print above 150,000 could push September hike probability towards 75% or higher, given that Chair Warsh has offered no forward guidance to buffer the market's interpretation. Conversely, a soft print closer to or below 60,000 would likely push September pricing back below 40% and potentially revive easing expectations, which is precisely why the range of market outcomes today is so wide.
Lizzie, Cloudflare, and Sezzle were standout earnings winners this week, while AppLovin dropped roughly 20%, Datadog nearly 19%, and the trade desk was down 24% after hours. What's the read-through for software and ad tech from this earnings season?
The read-through is that the market is becoming extremely selective and punishing any hint of margin pressure or guidance disappointment with outsized moves. AppLovin, Datadog, and the trade desk all had different stories, but the common thread was expectations that had gotten too stretched relative to the delivery. Cloudflare and Sezzle showed there's still genuine appetite for software winners, but you need clean beats with forward visibility, not just revenue growth. And Figma's 14% decline after AI infrastructure costs hit margins dragged enterprise software peers with it. The ad tech space specifically is under pressure from both macro uncertainty and the broader AI capex debate, and that combination is making the sector a particularly difficult trade heading into the back half of the year.
Michael Burry is out with charts showing a negative correlation between Magnificent 7 AI capex and stock performance. Nvidia, Microsoft, Amazon, Alphabet, and Meta all trading below their 10-year valuation averages, while Apple is the outlier. Is that argument gaining traction, and how are traders positioning around mega-cap tech right now?
It is gaining traction among a meaningful cohort of traders, and the data is hard to argue with. The negative correlation Burry is drawing between forward capex estimates and stock performance is visible in the charts, and Fitch, echoing similar concerns about global credit market vulnerability, adds institutional weight to the thesis. Apple trading above its 10-year average PE, while the heavy AI spenders trade below theirs, is a notable divergence the market has been pricing in gradually. And Meta's volatility this summer, Zuckerberg's net worth swinging by double-digit billions twice, is a direct reflection of Wall Street's unresolved debate on AI spending ROI. Positioning within megacap is now decidedly defensive, with traders trimming concentration risk and rotating toward names with cleaner capital allocation stories. And the risk premium attached to AI-heavy names is meaningfully higher than it was 6 months ago.
Lizzie, Brent crude is in the low to mid-80s with Strait of Hormuz tensions escalating, Houthi attacks on Saudi Arabia, Iranian threats targeting US warships. What does that mean for inflation expectations and rate-sensitive sectors?
The energy situation is adding a meaningful inflation tail risk that the market hasn't fully priced in yet. Brent was up nearly 4% on Thursday to around $80 a barrel, and with 20% of global oil and gas flowing through the Strait of Hormuz, the geopolitical premium in crude is not dissipating quickly. For rate-sensitive sectors, banks, mortgages, real estate, small caps, the combination of elevated treasury yields near 4.6% on the 10-year and rising oil prices is a genuine double headwind, because higher energy costs feed directly into CPI expectations and give the Fed additional cover to stay restrictive longer than the market would like. The New York Fed's one-year inflation expectations data is also scheduled for release today, which could add another data point to that picture and keep the pressure on rate-sensitive trades into the close.
Let's get to crypto. Bitcoin is holding just above $64,000 but down 26% year-to-date and struggling to break through that $65,000 to $66,000 resistance zone. Any credible catalyst on the horizon, or are we firmly in crypto winter?
The honest read is that we're in a consolidation phase with genuine crypto winter characteristics. Bitcoin peaked near $126,000 in October and has been grinding lower since, hitting a 52-week low of $57,700 in July before recovering. And technically, the $65,000 to $66,000 zone has capped every meaningful rally attempt since June. A break above $66,000 could trigger short covering and historically kickstart broader moves. But fundamentally, the market needs fresh liquidity and a sentiment shift that isn't materializing from regulatory progress alone. The Clarity Act carries only a 30% passage probability and is absent from the Senate floor schedule ahead of the August 10th recess. Arthur Hayes has framed the consolidation range as 60,000 into 70,000 with a potential dip to 50,000, which is consistent with the on-chain picture, showing 54.6% of Bitcoin's supply and profit and the market in redistribution rather than structural breakdown.
Solana has fallen 10% over the past 30 days, broken key trend line support with analysts flagging $68 as near-term support and downside scenarios to $60. How credible is that deeper case?
The $60 downside scenario is credible given the technical setup. SOL is trading below $80, forming a bearish descending price channel, and the RSI sitting at 44 approaching 40 would confirm a sell signal on further deterioration. The on-chain picture is genuinely concerning because daily active users are showing a bearish moving average crossover, and DEX volumes dropped 9% to 51 billion in July, which is particularly notable given that Solana's activity is actually comparable to 2024 levels, when SOL was trading between £130 and £190s. The valuation multiple compression is significant. There's a potentially constructive development from the SGP 003 validator proposals that could increase SOL burns up to 14-fold, but that proposal currently holds only 5.8% of active stake support against the 15% threshold needed by August 18th, so it's not a catalyst traders can rely on in the near term.
TeraWulf and CleanSpark are both pivoting hard from Bitcoin mining into AI data center infrastructure. TeraWulf with $27 billion in contracted AI revenue, and CleanSpark signing a $6.6 billion HPC lease. Is this the trade within the crypto space that's actually working right now?
It is absolutely the trade that's working within the crypto-adjacent universe, and Wolf, up 248% over the past 12 months, tells that story clearly. TeraWulf's pivot is the more advanced, HPC revenue at $32 million, representing 70% of total sales, with $27 billion in contracted revenue from tenants including Anthropic and Core42, delivering $180 million in annualized recurring revenue. That's a fundamentally different business than it was 2 years ago. CleanSpark's $6.6 billion 20-year triple net HPC lease at Sandersville carries a nearly 100% net operating income margin, which is exceptional, though CLSK shares fell about 3% on the news, likely reflecting execution risk given capacity delivery doesn't begin until Q4 2027. The broader read-through is that power infrastructure and GPU-adjacent real estate are where institutional money is flowing when it wants crypto sector exposure without direct BTC or ETH price risk.
Finally, Lizzie, Berkshire reports Saturday, and roughly 85% of S&P 500 companies have already posted with earnings growth tracking for the strongest year since 21. Does that backdrop give the market enough cushion to absorb a hot NFP print this morning?
It provides a meaningful floor, but probably not enough cushion to fully absorb a print above 150,000. The earnings backdrop is genuinely solid, and Berkshire on Saturday is more of a sentiment anchor than a volatility catalyst. But the Fed risk is simply too dominant today to be offset by backward-looking earnings data, because a hot NFP reprices the forward rate path in real time, while Q2 results are already in the rearview mirror. The more important threshold for traders is whether today's print is strong enough to push September hike probability above 65%, because that's the level where the good news is bad news dynamic starts to fully dominate the broader earnings cushion.
That wraps up today's Morning Bell. A big thank you to Lizzie and Steve on what is shaping up to be a critical morning for markets. Remember, this is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. Have a great Friday, everyone.